Welcome to Iron Financial, the place where we forge stronger portfolios by stress testing the market hype. So Domino's Pizza just dropped its latest earnings for Q4 and the full year 2025, and right now, the market is absolutely loving it. The stock is jumping, the headlines are glowing. But you know, our job here isn't to read headlines, it's to inspect the blueprints. Today, we're doing a full structural analysis. We're going to break it all down and figure out if Domino's is truly building a long-term dividend fortress that can weather any storm, or if what we're looking at is just a house of cards, looking great for now, but ready to collapse at the first real headwind.
Okay, let's start with the big, flashy number that has every single income investor paying attention, a 15% hike to the quarterly dividend. Now, you have to think about the current economic environment we're in. A company just doesn't approve a double-digit increase like this unless its management has absolute rock-solid confidence in the cash-generating power of the business. This isn't just a token gesture to keep shareholders happy. No, they're basically broadcasting to the world, we are a cash machine and we are committed to sharing those profits directly with you. This is a huge foundational pillar for the bull case. It signals real strength, real stability, and a focus on shareholder returns that, frankly, you don't always see.
Exactly. And this slide, this right here, shows you how they can afford that huge dividend hike. This isn't some kind of financial engineering or accounting magic. It's just pure, unadulterated, operational power. Just look at that number. Full-year free cash flow grew by over 31%. That's not a small increase. That is a massive jump. And that is the lifeblood of shareholder value, right there. We are talking about an increase from roughly $511 million in 2024 to over $671 million in 2025. And that's cash after all the bills are paid. That's the money that pays down debt, buys back stock, and fuels those bigger dividend checks. A cash explosion like this, well, it's a sign of a company firing on all cylinders.
But you know, as we always say around here, strong headlines can often hide underlying weaknesses. Every fortress, no matter how imposing it looks from the outside, needs a thorough inspection. So, today we are putting Domino's to the test. Here's the game plan. We're going to start by defining what we even mean by a dividend fortress. Then, we'll forge the bull case, piece by piece, looking at all the strengths. But after that, we're going to start looking for any cracks in the armor. We'll stress test their international growth engine, and then, only then, will we weigh all the evidence and deliver our final verdict.
So what is a dividend fortress? It's a term we use here at Iron Financial for a very specific type of company. See, it's not just about having a dividend. Lots of companies have those. It's about a business structure that is designed from the ground up to support and, more importantly, to grow that dividend sustainably for the long haul. You can think of it like this. It's built on a foundation of predictable, growing cash flows, and its walls are made of a disciplined capital allocation strategy. The end result isn't just a quarterly payout, it's a symbol of true financial strength and management's deep-seated confidence in the future.
And the single most important building material for that fortress is free cash flow, or FCF. It's a beautifully simple but absolutely brutal metric. After you've paid for all the pizza ingredients, the labor, the utilities, and maintaining all the ovens, this is the cash that is actually left over. It's really the purest measure of a company's raw profitability. But, and this is key, it is not enough to just see that number go up. We need to know how it's going up. Is it from sustainable, core business growth, or was it some one-time event that's not going to happen again? You see, a big FCF number is good, but a big, repeatable FCF number, that's what separates a decent company from a true fortress.
Okay, let's start forging that bull case. The headline numbers, as we've seen, are impressive, but we need to go deeper. We are looking for the foundational pillars. The steel beams that suggest this growth isn't just a temporary sugar rush, but a sign of genuine, long-term structural strength. So we need to analyze the revenue, the cash flow, and the underlying strategy that's driving all these results to see if Domino's truly has what it takes to be called a financial powerhouse. Let's see the evidence.
The steel frame of this entire bull case, it starts right here with top-line revenue growth. Just look at the fourth quarter. Revenue climbed a really solid 6.4%, hitting $1.54 billion. And for the full year, it's up 5% to nearly $5 billion. Now, this isn't some wild, unsustainable, high-tech growth number. This is the kind of steady, powerful expansion you really want to see from a mature industry leader. It tells you they are methodically taking market share and expanding their reach. This is the fundamental starting point. More sales coming in the door, providing the raw material for everything else.
And this is the engine room. That revenue growth we just saw translates directly into financial firepower. This bar chart just makes it crystal clear free cash flow jumped from $511.6 million in 2024 to over $671 million in 2025. That is not an incremental improvement, folks. That's a quantum leap in cash-generating ability. This chart really shows how incredibly efficient they've become at turning $1 of sales into $1 of hard cash. And this massive increase is what funds everything the bulls love, that 15% dividend hike, the $80 million in share buybacks they did in Q4 alone, and the strengthening of their balance sheet. This right here is the core of the bull argument. And this quote from the CEO, Russell Weiner, it really reveals the philosophy behind these powerful numbers. I want you to pay close attention to that phrase, creating our own tailwinds. See, this isn't a company that's just hoping for a favorable economic environment or waiting for consumer trends to go their way. No, this is a company that is actively driving its own growth through very specific strategic initiatives. The focus on getting stronger every single day points to a culture of continuous operational improvement. It suggests that this success isn't built on short-term gimmicks, but on a durable, repeatable strategy. And that's the kind of long-term, process-oriented leadership you want to see. Now, I have to admit, even as a skeptic, this point is incredibly strong. In an inflationary environment where literally every other company is talking about pricing power, which is just code for passing rising costs onto their customers, Domino's went the other way. In the fourth quarter, their menu pricing was flat. They didn't raise prices. And yet, franchisee profits still grew. This is what they call profit power, not pricing power. They are driving profits through sheer volume and operational efficiency, fueled by their hungry for more strategy, not by squeezing their customers. This demonstrates a deep, resilient competitive advantage that is very, very hard for anyone else to replicate. It's honestly one of the most compelling parts of the entire bull case.
All right, the bull case is laid out, and I think we can all agree, it's formidable. But no fortress is invincible. Now it's time for us to do our job and inspect the walls for weaknesses. Every glowing earnings report has footnotes, risks, and qualifications hidden away in the back. And this is where we dig past all the triumphant headlines and get into the nitty-gritty fine print. We need to identify the potential stress points that could threaten the entire structure. Every investor needs to understand not just the potential upside, but the potential points of failure.
And this is the exact question every single investor should be asking themselves right now. The market reacts instantly to the big numbers, the revenue beat, the dividend hike, we get it. But the real story, the one that determines long-term success or failure, is so often tucked away in the risk section of the earnings call transcript. So let's put on our hard hats and start looking for the vulnerabilities that the market might be overlooking in its initial excitement.
And here they are. The first potential cracks we found, and these are pulled straight from the company's own analysis. First up, outsized insurance costs. Management themselves flagged us as having a meaningful negative impact on their U.S. company-owned stores. That is a direct hit to margins, period. Second, a persistent drag from a specific international segment, Domino's Pizza Enterprises, or DPE. We're going to dig into that a lot more in a minute, but just know it's a significant anchor on their whole international growth story. And third, the general warning that macroeconomic pressures are expected to continue, which could squeeze consumer spending. These are not trivial concerns. They are real, acknowledged headwinds for the coming year.
And here's another critical little detail that gets lost in all the celebration over the revenue beat. They actually missed on earnings per share. Okay, it was a slight miss, $5.35 versus the $5.39 that was expected, but a miss is a miss. And when a company beats on revenue but then misses on earnings, you have to immediately ask the critical question. Is profitability under pressure? Are those rising costs we just mentioned, like insurance, eating away at profits more than the analysts anticipated? It's a small crack for sure, but it suggests that profit power story might not be quite as seamless as it looks on the surface. Now, some might see the nearly $4.8 billion in debt on the balance sheet and see that as a major weakness, but context here is absolutely critical. Let's look at this table from their own 8K filing. The crucial point isn't the total debt number itself, but how they're managing it. And the key metric to watch here is the leverage ratio. As you can see, it has actually improved pretty significantly, dropping from 4.9 times earnings in 2024 all the way down to 4.4 times in 2025. They're actively deleveraging, so while the debt load is high, their earnings are growing even faster, which makes that debt much more manageable. This isn't a sign of distress, it's a sign of real financial discipline. They're using their cash to fortify the balance sheet.
Okay, so a huge part of the long-term bull thesis for Domino's is global expansion. I mean, the U.S. market is relatively mature. The international opportunity, on the other hand, is vast. Therefore, the health of that global growth engine is absolutely critical to this stock's future. So if it's not firing on all cylinders, the entire long-term growth story could be at risk. We need to put this segment under the microscope and see if it can really bear the weight of those high expectations.
And this is perhaps the most concerning piece of evidence we found in the entire report. This is a direct quote from management on the earnings call. It is so important, let me just read it again. "I do not believe there's a pathway to get to the 925 that we initially guided to." They're explicitly, publicly walking back their previous guidance on store growth, and they're blaming it squarely on the poor performance of DPE, which is their master franchisee in big markets like Australia and parts of Europe. This is a direct admission that a major component of their international machine is broken and is dragging down the performance of the entire segment. This is a significant structural issue. But let's be fair and frame this correctly. Yes, the DPE problem is a real and significant headwind. It's absolutely dragging down same-store sales and forcing them to lower their store growth targets. It is a serious problem, but it is not the whole international story. On the other side of the ledger, management was very quick to highlight accelerating growth in other key markets, specifically India and China. So the bull case here is that the strength in these massive Asian markets is powerful enough to offset the weakness elsewhere. The global engine isn't completely broken, but one of its biggest cylinders is definitely misfiring, and that's a problem.
So, it's time to weigh all the evidence. We've examined the solid foundation of the bull case, and we've hammered on the walls to find all the potential cracks. Now, we have to put it all together. Is the strength of that cash flow foundation powerful enough to overcome the severity of the cracks that we've identified? Is this a genuine investment opportunity, or is it a classic value trap just waiting for an unwary investor?
It really all comes down to this, doesn't it? The bull case is built on an undeniable foundation of financial strength. I mean, we're talking about explosive free cash flow growth, an aggressive commitment to shareholder returns, that really impressive profit power driving margins, and a balance sheet that is actively getting stronger every quarter. But the bear case is just as clear. You have real margin pressure from rising costs, you have a significant and acknowledged drag on international growth from that DPE segment, you have the persistent threat of macro headwinds, and you have the simple fact that they missed their bottom line earnings expectations. It's a classic battle between stellar operational performance on one side and significant external and internal risks on the other.
So, where does Wall Street land in this whole debate? Well, looking at the analyst consensus, the professionals seem to be siding pretty heavily with the bulls. According to Yahoo Finance, the average price target from 33 analysts is over $482. Bar chart's survey of 24 analysts comes in a little lower, but still strong, around $449. With the stock currently trading around $400 after this earnings pop, both of those targets represent some significant potential upside. So, despite all the risks we've detailed, the majority view on the street is that the company's financial engine is strong enough to power right through these headwinds and drive the stock higher.
And that leaves us with the final crucial question that you, as an investor, have to answer for yourself. Are you looking at a company building a durable, cash flow-fueled empire that can truly withstand any storm? Or the cracks we found, the margin pressures, the significant international stumbles, are those early warning signs of a foundation that isn't quite as solid as it appears on the surface? Here at Iron Financial, we provide the analysis and we stress test the numbers. The final decision is always yours to forge. Thank you for joining us.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.